suddenly there's a lot of attention being paid to the metals markets. After yesterday's Fed meeting, the Fed announced that they're quite a bit more dovish than the market was expecting. As a result, both gold and silver rallied, and everybody's getting excited, as they always do when gold and silver rallies, particularly the gold bugs, who are still kind of buzzing over the 2011 heyday in the metals markets. However, we'd like to pull people back into reality and show them that if you look at a weekly chart in gold, we've basically gone nowhere since 2013. The market has been trading in a relatively well-defined trading pattern. At the moment, we happen to be putting in higher lows, whereas for the first couple of years, we were putting in lower lows. But in the end, we're still running into a pretty big ceiling in the 1350 to 1370 range. Our best guess is that any gains that we see in the short run in gold off the Fed news will probably be limited to about 1340. We're getting this from the daily chart. However, we can't rule out a run to 1350 to retest the highs that we saw last month, or maybe even 1360. But in the end, the point is the upside's probably limited. If we haven't broken out of this trading range since 2013, I don't see any news that's currently in the cycle that's going to be able to do that. Further, if you look at seasonal charts, I happen to be a fan of seasonals. They're definitely not the end-all be-all to trading, but you definitely want to pay attention. The markets tend to follow seasonal patterns more than they don't. Gold generally tops out in late February, and if you scroll back a couple of weeks, when gold put in a high near 1355-ish in the futures markets, that was on February 22nd. So far, so good when it comes to the seasonal pattern. On a side note, anybody that follows our analysis might be wondering how we could possibly be bearish the U.S. dollar and bullish gold. Bearish the U.S. dollar and bearish gold at the same time. Generally, those two assets go in the opposite direction. But the reality is, if you look at the correlation between these two markets over the last 180 trading days, they've actually been correlated more than they're not. In fact, they've settled in the same direction about 40 to 45% of the time. So it's very possible that if the dollar continues to move lower, gold rolls over and follows suit. In our estimation, like I mentioned, we can't rule out one more little last hurrah rally, retesting highs and that sort of thing. But in the long run, we're looking for gold to probably see somewhere in the 1280 area or even lower, maybe the mid 1250s. So if you are bullish gold, just be mindful of there's trading resistance up above, and the odds are we're probably going to hold that resistance, roll over, and come back down towards the bottom end of the trading channel.